and welcome to the Adam Smith Institute, the UK's neoliberal think tank. My name is Matthew Kilcoyne, and I'm the Deputy Director here. For the first time in months, I'm coming to you live from Westminster as the UK begins lifting the lockdown. I'll be joined tonight by Scott Sumner. Scott is the Ralph G. Hawtrey Chair of Monetary Policy at the Mercator Centre at George Mason University. He's also Professor Emeritus at Bentley University and a Research Fellow at the Independent Institute. In his writing and research, Sumner specialises in monetary policy, the role of the international gold market in the Great Depression, and the history of macroeconomic thought. Scott wrote for the ASI back in 2011 when he authored The Case for NGDP Targeting, and is also rather handily the author of our latest report, out today, The Urgent Need for NGDP Targeting, Learning from the Last Crisis. It's a handy time as the ex-Chancellor of the Exchequer, Sajid Javid, makes a call too for the Centre for Policy Studies for NGDP targeting to become adopted by the Bank of England. We're also joined by Anthony J. Evans, Professor of Economics at ESCP Business School, and he wrote for the Adam Smith Institute in a paper entitled Sound Money, an Austrian proposal for free banking, NGDP targets, and OMO reforms back in 2015. Now, during this pandemic, we've examined the response of Western states to the immediate public health threat, the fiscal response, both in the immediate term, and what to do with tax and spend policies as restrictions on trading are eased, as well as the legislative response required to allow more liberalization in future. But one area that's been unexplored in recent months has been monetary policy. This is partly due to the success in recent decades of the depoliticization of it. Central banks across the West gained independence from the political whim of parties in democratic countries, including here in the UK with the Bank of England. The bank's current mandate to provide financial and monetary stability is met mainly through an aim to provide low and stable inflation at a government target of 2%. A government set target. This owes itself largely to the economic challenges that preceded it in the 1970s and 1980s. In 1975, year-on-year inflation peaked at 24.3%. Keynesian consensus on economic policy, which had underpinned largely successful economic outcomes of the previous 3 decades in Western Europe, had no convincing response to prices rising at this kind of a rate. Monetarism and neoliberalism stepped into the gap. Decades of low inflation and stable money supply have flowed from the mandate that fixates on inflation. But has it really, do central banks actually look at other things too? And if they don't, maybe should they? We're going to kick off with Anthony we're going to kick off with Scott. Now he's joined us. Good to see you, Scott. Who will hopefully be able to tell us a little bit about what NGDP targeting is, what it's for, and why now is the right time for it. Now, imagine, Scott, that I'm the layman that I actually am when I'm talking about these things. And let's introduce a new mandate for central banks. Oh, Scott, you're not muted. You're unmuted. Bear with me one second. I'm just going to unmute you. Maybe. Oh no, I still can't hear him. Scott, can you hear us? I'm not sure I can. One thing we'll do, have we managed to set up your speaker? Matthew, I'm going to go to Anthony, and he's going to give us a little bit of a background as to his perception of it. And then we'll come back to Scott. Oh, wait, we've got a headline. Yes, if you put that in, then we'll come back. Anthony, I'm going to go straight to you, and you can tell us a little bit first.
Okay, do you want me to step in for the first question you raised, or would you like me to?
Yes, if you don't mind.
Sure thing.
Yeah, if you go.
So I think the best way to think about NGDP targets is in terms of the equation of exchange. So if you're familiar with Milton Friedman's big contribution to monetary economics, which is the concept that MV equals PY. This basically tells us everything we need to know about how central banks can adopt different targets, because originally in the 1970s, it was quite common to adopt a money supply growth rule, whereby central banks can just try and target the growth rate of the money supply. An alternative to that, as you mentioned, is when central banks in the 1990s, it became very popular for central banks to target inflation. And an alternative is an NGDP target, which is instead of focusing on the money supply or focusing on inflation, it's to focus on the entire right-hand side of the equation of exchange, which is, it goes by various names. You can think of it as nominal income. It's P times Y. Nominal GDP is the typical measure that we would take for that in the UK. And it's basically saying, instead of just focusing on consumer prices or a relatively small bundle of prices and trying to ensure stability in that, it's looking at the entire nominal income stream for the economy as a whole and trying to generate stability at that level instead.
And when you're doing that, when you're looking at not just inflation, but also the nominal income level of the economy, why do you need to not just look at inflation? What is special about the more broad-based look rather than that specific look, which has delivered such steady money supply in the Western economies over recent decades?
I think there's a couple of reasons. I might be treading on Scott's toes. This is microphone. It looks like he might be set up with his microphone. Should we give him a chance?
Hello, Scott. Can you hear us? No, I still can't hear you.
So I guess, one way to think about this is whether or not you want to have a stable environment for prices. And this was the idea in the 90s, was that given that ultimately all a central bank can do is control the level of inflation, if a central bank does successfully control the rate of inflation and successfully anchors people's expectations to that inflation rate, then everything else almost falls into line. And I think there's a certain logic to that, which is that ultimately that is all that the central bank is able to control is the amount of inflation over the long term, at least. But then there's a kind of trade-off here, whereas if you are focusing on consumer prices, then it means that things like wage and debt contracts are adjusting in order to deliver that stability. So to one extent, it's essentially just shifting your focus from kind of consumer prices and moving it earlier on in the economy to wage and debt contracts. And many people would argue that it's that kind of wage and debt contract stability that's much more important for economic planning. Obviously, consumer prices play an important role in consumer decisions and decisions to make consumption and whatnot. But in terms of business planning, it's really wage and debt contracts that have the biggest capacity, I think, to create macro instability when they fall out of kilter with people's expectations. I think the big argument in favor, the big traditional argument in favor of NGDP targets in particular, is that they can deliver some different policy prescriptions than inflation targets. So a nominal GDP, if you target nominal income, this is allowing a focus not just on prices, but also on real GDP growth. It allows kind of output to adjust as much as prices. And so if you have a supply shock, for example, in an economy, then an inflation target is tipping the central bank in completely the wrong direction. If you have a supply shock, then this is going to, for example, if you have a positive supply shock, this puts downward pressure on prices, and you to some extent you want that to happen. You want prices to fall when times are good, when productivity is rising. You want real purchasing power to increase. Conversely, if there's a negative productivity shock, that typically leads to a spike in inflation, and that's exactly the wrong time for a central bank to be withdrawing demand from an economy. This is famously what we saw in 2008. And so precisely because a nominal GDP target means that the central bank doesn't need to distinguish between demand and supply shocks, the policy is consistent in both of those formats. That's one of the big key advantages.
Wonderful. Thank you very much. Yes.
Yeah, we can.
Oh, sorry for the technical problems.
No worries at all. Thank you very much for joining us.
Thank you for inviting me, and that was a very good explanation. So much of what I would have said.
Wonderful. Well, I'm going to let you carry on and go beyond as well, Anthony, there, because you have our latest paper out today. And what I really want to know about why right now is sort of perfect time to introduce NGDP targeting, and why we shouldn't just be focusing on inflation targeting.
Right. So as was indicated, the two advantages are stability for the labor market and also for the credit markets. And this is the sort of crisis that's going to put a lot of pressure, and already is putting a lot of pressure on both of these markets. Now, one thing that I would emphasize is that NGDP targeting can't perform miracles. So during this period, the first few months of this quarter, or even into the third quarter, it's inevitable that NGDP will fall well below what we would like. In my view, we should be targeting nominal GDP, say, a year out from now. And the real goal should be to have the growth rate, say, around 4% a year for the period of 2019 to 2021. There's going to be a dip in the second quarter that's pretty much inevitable. But after that dip, we should try to come back to the trend line. And the goal should be to provide enough income so that debt contracts in 2021 can be repaid, and there'll be enough total revenue in the economy to support roughly full employment in 2021.
Thank you very much. Just on a quick one from that, why is it important to have full employment in the economy? Why is that the focus? And why? And obviously, even from a basic point of view, why is it important to have fulfillment of debt-based obligations?
Well, I think what you want to do is avoid shocks that destabilize markets. So I don't think of monetary policy as actually solving problems. I think of it more in terms of refraining from causing problems. So, contracts are signed under a certain expectation of what's likely to happen to nominal income. And obviously, if you have an unstable enough monetary policy, you can have almost anything happen. You can have hyperinflation like we saw in Zimbabwe or Venezuela, or you could have extreme deflation like we saw in the 1930s. Both of those caused tremendous problems for credit markets. And the question is, what sort of rate of inflation or nominal GDP growth is optimal? And why is nominal GDP better than inflation? But nominal GDP is basically the resources that people have to repay debt contracts, which are in nominal terms, and also the revenue flow that is available to support labor contracts. So it's really a better indicator of macroeconomic stability than inflation. What you really want with monetary policy is not a policy that's going to try to sort of fine-tune the economy and solve every problem out there, but provide sort of a stable macroeconomic background so people can make decisions in the private sector with some assurance that they won't be hit by a dramatic, unexpected change in the flow of nominal income over time.
So making sure the government,
think about it. What's that?
To make sure the government doesn't pull the rug underneath people's feet when they're trying to pay their contracts. How would monetary policy have differed over the last few years if the bank had been explicitly targeting NGDP rather than inflation?
Well, the biggest difference would have been back during the Great Recession of 2008. So then nominal GDP in the US and in Europe, Britain, so on, fell fairly sharply below trend. In that case, nominal GDP targeting, I think, would have made the recession much milder and also would have made the financial crisis much milder. In recent years, it wouldn't have been actually much different from what a lot of central banks were doing, because once we got out of the Great Recession, nominal GDP grew at a fairly steady rate. Although I would argue in the early years of the recovery, the growth rate should have been faster as sort of a catch-up process. In other words, I favor a level targeting of nominal GDP, which is a promise to return to the previous trend line. So if you set a 4% growth target for nominal GDP, and during a recession you fall below that, you promise to increase nominal GDP fast enough to get back to that trend line. Same thing applies for an overshoot. If you have excessively strong nominal GDP growth, then you reduce the growth rate below trend to get back to the previous trend line. And that kind of policy is more stabilizing than one that lets bygones be bygones and just commits to a different trend line once you've had a shock. So the big mistake was allowing a big drop in nominal GDP around 2008 and 9, and then not trying hard enough to come back to the previous trend line once we'd fallen below it. By the latter part of the 2010s, then monetary policy was pretty much on course, in my view, at least in the United States. Although in Europe and Japan, they were still falling short of their inflation targets, of course.
Fantastic.
I could just add as well, in terms of the Bank of England, there's an argument to be made where they were kind of following an almost implicit NGDP target, because any time where they made a decision not to kind of see through, in their terms, see through inflation because of concerns for real growth, they are adopting a quasi NGDP target. And so certainly that if they had have been paying more attention to that prior to 2008, then possibly that wouldn't have happened, the crisis. But then since then, to the extent to which policy's been reasonably successful, some might argue that it's because they've been almost kind of backdoor paying attention to that.
And I think that's a question that I've heard policymakers here in Westminster say on the sly that they are sort of already following one. And that's actually part of like the reason why, Scott, we asked you to update and rewrite this paper. Like, there's an honesty that has to become with the monetary policy, isn't there? And how important is that sort of honesty and explicit targeting compared to sort of like just letting the bank, do it anyway, but behind the scenes?
Right, I think that's right about their trying to implicitly follow something like nominal GDP targeting. But I think the other mistake, and this kind of comes back to the level targeting point, is that when there's a major shock, central bankers all over the world tend to think in terms of the path of nominal GDP being beyond their control, not something that they're doing, rather something they're responding to. And I think that's a mistake. The central banks have to sort of take ownership over the path of nominal GDP. And level targeting, in a way, requires them to do that. So it makes very clear that if there is a shock that temporarily pushes nominal GDP off course, there's a commitment to really get back to the previous trend line. Without that commitment, policy can kind of drift and go for years where there's a stated desire to achieve some sort of target, but consistently falling short in one direction or another. And this tends to occur especially often when interest rates are near zero, because central banks tend to rely on interest rate targeting. When you're in normal times like the 1990s, early 2000s, then modern central banks do generally do a pretty good job of stabilizing growth in nominal income.
So interesting. By the way, for everybody who is watching, there is a Q&A button if you want to send in questions. We already have a few. I've already answered one of them. Mark, I think you heard me answer that. I'm going to go quickly into some that were sort of sent in. I sort of want to know, over the past few years, sort of people pay attention to monetary policy, but typically what they pay attention to, at least in the UK, is what happens to interest rates. And just interest rates. So, and there's a bit of a focus about returning to what's real rates, negative interest rates. We saw that in Switzerland first, and then across most of Europe. Are they a real long-term possibility here in the UK? Does it have much of an actual impact in the real economy? Should we be worried about that? About being paid to hold money for other people? Like, is there something underlyingly wrong in the economy if we have those?
Well, I have this phrase I use called never reason from a price change, which is the idea that we shouldn't just look at any price, including an interest rate, and make a judgment about what that means without thinking about what's actually causing the price to change. Now, in the case of interest rates, as you know, it's sort of a two-edged sword, so it can reflect a multitude of factors. High interest rates could be a tight money policy, or it could be an easy money policy that leads to high inflation rates and high interest rates. Conversely, negative interest rates could reflect either a very tight money policy that's pushed an economy into deflation, or it could reflect an easy money policy of cutting rates sharply to boost the economy. And over time, it's more and more likely that when negative interest rates persist for a long time, it's usually the case that it reflects a previous tight money policy that's led to very low nominal GDP growth. So when you look at the countries around the world that have negative interest rates, those are the countries with the slowest rates of nominal GDP growth. Conversely, places with higher rates of nominal GDP growth tend to have either zero or positive rates. And the higher the rate of growth, the more likely it is that interest rates will be positive. So this leads to a lot of confusion. There's this perception out there that central banks in certain places have cut rates into negative territory. The economies are still weak, therefore the conclusion is that monetary policy is ineffective. But actually what's occurring in most cases is that previous monetary policy was too contractionary, It led to very slow nominal GDP growth, and it was that drove interest rates to zero. I can give you one real world example of that phenomena. In the early 2010s, the Fed was more aggressive than the European Central Bank in promoting monetary stimulus. And a lot of European officials were skeptical of what Bernanke was doing. They thought it was too expansionary, and they didn't like the idea of cutting rates all the way to zero and QE and all this stuff. By 2013, Europe had had rates above zero for 5 years. They had never cut rates to zero until about 2013. But because they had a tighter money policy than the United States, Eurozone nominal GDP growth fell well below the level of the United States. That pushed market interest rates down towards negative territory. Eventually, the ECB was almost forced to cut interest rates into negative territory to reflect the weakness of their economy and engage in very aggressive QE programs. So they thought there was an alternative to what the Fed was doing, but it turns out there wasn't. By refusing to do a more expansionary policy early in the 2010s, they ended up having to be much more aggressive than the Fed in the latter part of the decade.
And Scott and Anthony, do you agree with the QE here in the UK over the recent months during the pandemic? Has it been the right response?
Do you want me to go first on that?
Yeah, go ahead. Go ahead.
Well, I don't know as much about it as I should, so let me make some general comments about QE. I generally think that most central banks are being too contractionary in this cycle, which might sound odd given that they're doing a lot of things. But I judge monetary policy in terms of outcomes, not inputs. And what we're seeing around the world is disinflation setting in. Inflation rates are falling well below the central bank target. That means the central bank policy is too contractionary relative to the needs of the economy. Now, with the very high savings rates during the the lockdowns, what you find is the equilibrium interest rate has fallen to very, very low levels. So central banks have to do more than before. But I think that they could also do things that are more effective for a given amount of effort. And level targeting would be one of these sort of low-hanging fruits that could be very useful in this crisis. That is promising to come back to the previous trend line, would itself make monetary policy more expansionary without them having to do any more QE at all. Because what level targeting does in a recession is it raises inflation expectations. And that makes the current stance of policy, whether it be interest rates or QE, more expansionary than it would be without a level targeting promise. The other point I would make is, I think, at least in the US, the Fed is doing too much in the way of credit allocation and should focus more on just injecting money into the economy and let the private sector determine credit allocation. In fact, when there's a failure of monetary policy, what you tend to get is both credit policies and fiscal policies as alternatives. And these are much more costly and inefficient than pure monetary policy. So I would prefer central banks just increase the money supply enough and make commitments about future policy that are strong enough so that there's an expectation that growth in inflation or nominal GDP will be on target. And that's the most effective way to assure the appropriate level of aggregate demand, not get into credit allocation or fiscal stimulus or other alternative policies.
Otherwise, we'll end up with economic scarring from
right. And this is a dilemma, I think, also for what you might call conservatives of various stripes. I did a blog post on this recently. One of the dilemmas here that I think a lot of conservatives don't understand is that a very contractionary monetary policy will lead to low inflation and low nominal GDP growth, and it will push interest rates down towards zero. Now, what happens at zero interest rates are two things that conservatives should be very worried about. One, there's a perception that monetary policy is ineffective, so fiscal stimulus, government spending takes over. Second, there's the, I'm sorry, I just lost my train of thought. Oh yeah, there's more effort in things like credit allocation and see what happens at zero interest rates is central bank balance sheets get much larger. So the demand for bank reserves becomes much larger because there's no opportunity cost of holding bank reserves. as central bank balance sheets get much larger than before, they start buying more unconventional assets. And as a result, central banks get much more involved in credit allocation than in a more sort of streamlined, simple monetary system where interest rates are positive. The central bank balance sheet is fairly small because there's not a large demand for bank reserves. And as a result, unintentionally, conservative push for very low inflation rates can lead to a situation where other sectors of the government feel much more urgency to get involved in interventionist policies than was the case, let's say, in the 1990s or early 2000s when interest rates were positive, and it was felt that the central bank could do the job of managing aggregate demand on its own.
So there's a question, I think.
Dilemma.
There's a question, I think, about, you have socialists on one side and you have socialists in another part of the government, and it's like, which one is worse in my head? But, and I think a few questioners have that sort of thing. Anthony, you've written about how monetary policy works within a free market economy and free banking as well. Akeem asks, French economist Jean-Marc Daniel says, if we put the banks in competition, we don't need a central bank. Why do we need a central bank at all to have this like mechanism? And I was wondering, do you have an answer to that? Why are we not just relying on, why do we need fiat currency? Why do we need a central bank at all?
I think it's always worth kind of opening up to that wider question about, are we just kind of tinkering at the edges when we fundamentally we need bigger reforms? Some would say that having a central bank conducting monetary policy is totally incompatible with free market approach that Adam Smith Institute typically adopts. I have a lot of sympathy for that position instinctively and intellectually. A couple of years ago, I have a talk. The title is Why We Should Abolish the Bank of England. And I gave that talk a couple of years ago at the Bank of England. Obviously, it didn't go down it clearly didn't work because it's still there. And so, given that we have a central bank, the question is, how do we reduce the harm that it does? And as Scott said earlier, central banks do have the capacity to do immense harm, both on the upside in terms of excessive inflation, but also on the downside in terms of allowing nominal incomes to contract. And we've seen that recently. So, the question is, how can we mitigate those downsides and what approaches should we take? And I think part of the reason why NGDP targets are appealing is that they do bring us closer to a free banking type system or an openly competitive system. It's not purely the NGDP target element, I think, that's important here. It's also how you administer it. And I think a lot of people lose sight of the fact when they hear NGDP target, they just think this is another way for central banks to exert their influence. But in fact, it changes quite dramatically how much kind of power and authority central banks have and how much discretion we give them. So you asked about quantitative easing, for example. I'm actually quite, I think the problem with how much quantitative easing the Bank of England have done is that it's not tied to anything specific. We don't know why they've chosen the amount of QE that they've done and what's going to happen in future time periods. But one of the advantages, I think, of how you could administer an NGDP target is by doing it through open market operations and restricting central banks to pretty much open market operations. You're stripping away a lot of the central bank activity that's so distortionary and ad hoc. You're really possibly limiting a central bank to its only really legitimate role, which is managing the supply of that which it has a monopoly over, and just focusing on the monetary base and using open market operations to I think is a means of conducting NGDP targeting. And you can strip away a lot of the other stuff that central banks do, which I think is perverse. Also, as well, the typical NGDP policy proposal is involved not just with the retrospective, quarterly figures that are produced by the ONS, but also taking a much more forward-looking approach, looking at market expectations, building institutions that actually, generate those market-type indicators. And when that's done, and when those things are combined, you then have a very strong rule-based system where you don't have much discretion. So I think it does bring us closer because it can limit the central bank's activities, and it can also be much more prescriptive over what it can do. I wouldn't be too worried about QE that the Bank of England were doing if it was if it was announcing it with a specific nominal, ideally objective in mind, and an NGDP target could well be something that fits that bill.
This is an interesting point, but one of the questions that we were discussing in the sort of the back rooms of the ASI when we were setting up this was how much discretion the ONS actually really has over how much of the, over explaining the size of the UK's economy by having effectively a free rein to say how much of the economy is public sector versus private sector. And how do you account for that? And how's that accounted for in the US in your model, Scott, as well?
Well, first let me backtrack a little and talk about this question of should we have a central bank and so on. I think that it's worth thinking about what would happen if a smaller country, smaller economy like Canada were just to abolish its monetary system and allow some other monetary system to spontaneously replace it, spontaneously develop. It's possible that the Canadians would decide to adopt a gold standard. It's also possible they would adopt the US dollar as their currency. I very strongly suspect it would be the US dollar and not gold that would be adopted if the Canadian government just completely got out of money entirely and left it up to the private sector. And so from that point of view, it's not clear to me that a fiat money system is necessarily that much less efficient than alternatives that have been proposed. But I am sympathetic to the free market critique of central banking in a number of other respects. For instance, I've advocated that central banks essentially target the price of nominal GDP futures or whatever it is they're targeting. If it's inflation, it'd be CPI futures contracts. And I proposed the guardrails approach where they take a long position on contracts, let's say at 3% nominal GDP growth, and a short position at 5% growth rates. And what this would do would allow people that are in the private sector who think the central bank is off course to bet against the central bank and profit if the central bank missed its target. And under this kind of regime in 2008, the market all would have been piled up on the bearish side, obviously. They would have been taking a short position, forcing the central bank to take a long position on nominal GDP futures. As a result, the central bank would have faced large losses if it didn't move much more aggressively to boost nominal spending. So I compare this guardrail system to like the beeper on a truck backing up into an obstacle. It's a warning device that monetary policy is off course. And if you really pursue this to the extreme and have nominal GDP futures markets determine the course of monetary policy, then you essentially take the central bank out of the decision of setting interest rates. Under that regime, monetary policy adjusts until nominal GDP expectations are on target. The market sets interest rates, the market sets the money supply. In a way, it's almost like a gold standard, only instead of currency being redeemable into gold, currency is redeemable into nominal GDP futures contracts. So to me, this goes a long way towards addressing the objection of libertarians towards a managed fiat money system. Because now all the government is basically doing is setting the yardstick. They're defining the value of a currency in terms of some objective measure, and they're letting markets determine the money supply and interest rates. Now you can argue about whether nominal GDP growth is the right thing to anchor money to, or it should be a fixed weight of gold or whatever. But I think you can go a long way towards addressing libertarian objections to fiat money if the system is much more clearly anchored and the central bank has much less discretion in setting things like interest rates in the money supply. So I'm sorry, repeat the question. I don't know if I fully answered what you were asking.
No, but you actually answered, I think you answered Charlie's question about how it would look like in practice and how open market operations might not lead to an misallocation of resources, because I think what you've actually explained that the futures contracts are what are being bought here, that they have that there is a there's a mechanism for government to be targeting, and therefore secondary markets exist under it.
Well, let me make one point about open market operations and distortion and so on. There's a choice here about how high an inflation rate or nominal GDP growth rate we want. If we set it high enough so that nominal interest rates are above zero, the central bank balance sheet can be very small as a percent of GDP, and was small prior to 2008. In that kind of environment, the central bank balance sheet can consists simply of treasury bonds, and the central bank is essentially one arm of the government buying back the debt of another arm of the government. So that's a very non-distortionary way of injecting money into the economy. And if the central bank balance sheet is kept fairly small because interest rates are positive, then I don't think we need to worry too much about open market operations being distortionary. But when interest rates get so low that you're in a situation like Switzerland or Japan, where the central bank balance sheet is 100% of GDP, inevitably they will buy a wider range of assets, riskier assets, and that's really when you're going to get into trouble. So I would suggest that we have to think very hard about what kind of target do we want, a target that will keep interest rates positive so that central banks don't have to do too much heavy lifting.
I wonder, Anthony, we've seen.
Could I just add on that point, because there's in the question there's a few terms that are, misallocation of resources or malinvestment, and I think the important point here is that you don't have a stable economy with a stable money supply, and so you need to recognize that the goal for even Austrian economists is monetary equilibrium, which is where the money supply adjusts depending on changes in demand for real balances. And in a free banking kind of utopian, no central bank world, that's the holy grail that people are trying to reach. And it's important to recognize that NGDP targets moves us in that direction. It's very similar because NGDP stability is a way of delivering that kind of monetary equilibrium, because in an NGDP regime, you are creating institutions where changes in velocity are offset by changes in the money supply, such that P plus Y is stable. So theoretically, that should mean that you've got demand and money, supply of money are kind of balancing each other out. It also means that interest rates should be at their natural rate because the demand and supply of loanable funds is equal. And those are the kind of the outcomes that you want from a free banking regime in terms of macro stability. And that's I think a big plus point of NGDP targets is that it if not moves you in that direction, but if functioning effectively delivers it.
Yeah, and I think there's definitely a case there to be made about the use of normative terms when describing various bits of monetary policies. They need to move the debate in and of itself to what do you want. I've got a question here from Eamon, but I'm just going to slightly change. Eamon Butler, who is my boss here at the Adam Smith Institute Director, but his question, I'm going to try and change it slightly, because he says that Friedman wrote about trying to conduct monetary policy by controlling interest rates is like trying to change Detroit's output of cars by controlling the price of steel. Are interest rates the best tool we have? I'm going to slightly amend that and ask, in fact, central banks appear to be reaching for QE more and more regularly than they appear to be moving for interest rates. Do interest rates have much of a future in terms of the central bank's toolkit? Or have they actually just moved away to unorthodox monetary policy? More wholesale? Scott?
Well, I compare interest rate targeting to having a car where the steering wheel works fine, except when you're driving on a twisty mountain road, then it locks up, but otherwise the steering works fine. So interest rates seem to work okay for central banks during most times, but when we're in an economic crisis, a deep recession, a financial crisis, and interest rates fall to zero, the mechanism locks up. So I think it's very dangerous to rely on a mechanism where it doesn't work when you most need it to work. And in my view, we'd be better off just discarding interest rates entirely as a tool of monetary policy and simply rely on open market operations guided by nominal GDP futures markets. Now, I don't think that's going to happen. Even after the 2008-2009 recession, as soon as they had the chance to go back to interest rate targeting in the US around 2015, they started raising interest rates even before they had unwound the QE program fully. So central banks are very strongly attached to interest rate targeting. And unfortunately, I think it's going to be with us for a while. But my preference would be moving away from that towards a tool that doesn't have a zero bound problem. And by the way, there's actually many alternative tools that don't come up against a zero bound like interest rates. I believe the Central Bank of Singapore uses exchange rate as a tool instead of interest rates. And there's no zero bound problem for exchange rates. They can be moved up and down as much as the central bank wishes. So we've picked, ironically, one of the worst possible instruments of policy, that is nominal interest rates. And we've stumbled into it for historical reasons, but certainly I think if we'd known a few decades ago how often we would be at the zero bound in recent years, we would have picked a different type of policy tool.
Interesting. I've got. We didn't quite get onto it, so I'll go back to you, actually. The Office of National Statistics sort of guesstimates the size of the public sector, and that can have quite a perverse impact on your NGDP target. So I was wondering, what are your thoughts about officials, arms of the state, gaming their own system, and whether that's something that can be overcome?
Well, I mean, I think for me, the main Achilles heel of an NGDP target is the quality of the data that you get relating to NGDP. So trying to move towards expectations, I think, helps with that to some extent, because you're less likely, I think, to be kind of swayed by having to wait for quarterly figures that get revised heavily, and then you're constantly looking backwards at past figures that are being revised, and everybody's jumping backwards. You have that forward look, which I think is helpful. I think that's an inevitable consequence of having any indicator that you're trying to target. But there's no, right now, if anything, now is a good time to switch to that, I think, because if you look at the CPI basket at the moment, there's massive changes in consumption patterns based on lockdown. I don't think any central banker is looking at CPI as being an accurate indicator of inflation relative to what they were looking at previously. So the quality of national statistics is always going to be relevant. There's an argument that the reason why the Bank of England allowed NGDP to collapse in 2008 was because they had faulty GDP data rather than they were wedded to an inflation target. But I think that's part and parcel of having a central bank that has to look at something.
Thanks. Alan asks, we've talked about MV equals PY, but all the discussion has been about MP and Y. What about V? Can central banks actually act on this? Do we want them to? Or do we just have to accept what it is and adjust M in response? One for you, maybe, Scott.
Okay, so probably in the short run, we have to accept movements in V for reflecting shocks to the economy. V is going to increase a lot in this kind of environment, like the recent lockdown around the world. But again, looking longer term, there's a lot that can be said about that. When I talked earlier about the large central bank balance sheets in places like Japan and Switzerland, I was implicitly talking about a very low level of velocity. And that's, again, a decision variable. So if we as a society decide we want to have a fast enough nominal GDP growth rate or a high enough inflation rate so that nominal interest rates stay above zero, in that environment, V will be much more stable. We can have a much smaller so-called monetary base, that is central bank balance sheet, and a more stable one. V will fluctuate much, much less when we keep nominal interest rates above zero. And the reason for that is when nominal interest rates fall to zero, the cost of holding money essentially disappears. There's no opportunity cost of holding even non-interest bearing money. So velocity falls very sharply because people hoard lots of money of all sorts. And if you look at the data, I believe for the UK also, but for the US, you see this recent spike in demand for money. Both money in banks, currency, all types of money are in great demand now in a period where interest rates have fallen to zero. So in the short term, we have to just adjust to a shock to velocity, adjust the money supply to keep nominal spending stable. But in the long term, we can develop a monetary system where velocity itself will be a more stable variable, and we won't have to do such heroic actions with the central bank policy. We can have a much more stable money supply and velocity.
Fair enough. And I'm going to ask you both this. One of the things I like hearing at the ASI is what's known as sort of what we call strong manning rather than straw manning. What's the best argument you've heard against NGDP targeting, which you think causes you the most headaches with the policy proposal? And I'm going to go to Anthony first.
So I'd say the quality of national accounts and the extent to which they're subject to revision. I think one downside is I don't think anybody advocates NGDP targets on the grounds that they have full confidence in GDP figures fully reflecting everything that's most important about ensuring nominal stability. So there's a trade-off between the fact that the general public are familiar with GDP figures and that they have a lot of attention. But you know, I could quibble as to whether or not GDP is the right thing to capture here. There's an argument that it's an incoherent middle ground between, on the one side, just focusing on the consumption of final goods, so not having capital goods at all. And then at the other extreme, some people say, well, if you're going to kind of include capital goods in your measure, then you may as well include the entire capital stock. I think that theoretically, I'm inclined to think that the MV equals PT equation is possibly more appropriate, and there might be some more attention on transactions rather than income. But then, you know, if you're including transactions, then why not include financial transactions, and the real economy becomes essentially worthless. So for me, NGDP, if it weren't for the fact that GDP wasn't the key macroeconomic indicator, then I think you could have a more productive discussion about what the best indicator to target would be. But I think that's the downside, is that, you know, you're cashing in on the value of the fact that it's well known and well watched, and the general public are familiar with it.
How about yourself, Scott? The best argument against?
Well, I think nominal GDP is probably not the optimal policy target. I think it's close to optimal. But in some economies where, say, commodity markets are a much bigger share of GDP, it could be seriously flawed. I often use the example of an oil exporter like Kuwait or Saudi Arabia, where if there were a huge change in the international price of oil and you were targeting domestic nominal GDP, you'd have to shrink the non-oil sector if the price of oil rose sharply to keep total nominal GDP roughly stable. When you look at things that way, there's a strong argument that what you really want to stabilize is something like total labor compensation in the economy. Now, for the US, where the commodity markets are less important, expected growth in total labor compensation and overall nominal GDP track each other fairly closely over time. But that's certainly one objection. Earlier, you mentioned gaming the system. I do think any monetary system can be gamed. Indeed, in one sense, the gold standard did poorly during the interwar period because it was being gamed by national governments. So almost any monetary system in some sense relies on the good faith of the government not to try to distort the system. So for that, I would say that when there are changes in definition of nominal GDP, such as when the US added computer software as to investment, you get a one-time sort of level change in nominal GDP. The system would have to be adjusted so that you would target along a pre-existing trend line and not let those kind of definitional changes distort the economy. So it does require a little bit of good faith in terms of not gaming the system or changing definitions in a way that distort the objectives. But I think that's true of any monetary system. And again, the other point is the commodity markets can be distortionary when you have countries where commodities are a big share of GDP.
Yeah, I was speaking quite a bit before everybody joined. I was speaking to Anthony about Ireland, which has quite large shocks one way or another every month. And so, like doing this on a monthly basis, you'd end up with huge swings in what you were doing if you're doing this on an NGP target. Julian Jessup from our friends at the IEA has asked a question, and I think as we go into the final furlough, I'll bring this sort of politicization up as well. But if it ain't broke, don't fix it. Maybe inflation targeting is widely understood as anchored inflation expectations very well. It's also a heavily depoliticized issue, although we and the ex-chancellor have brought it up. We're not the only games in town. We know that the modern monetary theorists, despite not being monetarists or a theory or even that modern, have got their own propositions. Are we in danger of throwing the baby out with the bathwater in terms of stability that we've seen from inflation targeting in recent decades? Anthony, I'll come to you first, and I'll come back to Scott for that.
Well, I'd say that it is. I mean, it's not broke to the extent to which it doesn't function, and you know it's incoherent. But it's not working as originally intended. It's changed dramatically. So the Bank of England really pioneered the one target, one tool approach, and you know that was the focal point. It was different to the Fed that had a dual mandate and the ECB that had two pillars, but the Bank of England was one target, one tool, very simple, very straightforward. And it didn't work, it failed. So they've adopted QE. So now technically, you know, officially, if you go to the Bank of England Museum, then they'll explain it as a single target, but now there's two tools that they have. But obviously QE isn't the only additional tool that they've adopted since the financial crisis. So you've got all of these different ad hoc tools that are being used in addition to interest rates now that they're so low. And also they are completely inconsistent, I think, in terms of the inflation target. You have some people sitting on the MPC who are interpreting the inflation target to be delivering 2% inflation in 2 years' time. Sometimes you hear some people talking as though their aim is to deliver an average rate of 2% over a certain period of time, and they're two very different things. The latter is essentially a level target over a long enough time horizon. And we've also got unemployment thresholds that have been built into forward guidance, and clearly there's much more focus on other indicators, possibly even NGDP. So that monetary policy framework that the Bank of England adopted when it took on independence, they're not applying it anymore. They are in name, but the period of emergency monetary policy since 2008 is ongoing. And you know, every year that passes, every new crisis, the tools are changing, the target is shifting. And we're losing sight of that clarity. So I do think, you know, I've been surprised that it's taken this long for the Bank of England to go back to just defining clearly what the framework is. Maybe it's based on targets and tools, or maybe it's another way of explaining that. But I think it's long overdue having a new approach, and NGDP targets are well placed to provide a very clear, very consistent thing that will work in good times and in bad as well.
And Scott, are we at danger of throwing the baby out with the bathwater? I mean, I think I might be able to know the answer to this question, given you've devoted quite a large part of your life to it. But I'll let you answer.
First of all, I'd like to make the following point very forcefully. If we are using fiscal policy, and we are using fiscal policy in many developed countries all over the world, then the monetary policy is broke, period. Monetary policy is supposed to deliver the appropriate level of nominal spending. If we're having to use fiscal policy, then something is wrong with the monetary policy regime. So that's the first point I would make. And I think one of the biggest flaws is the lack of level targeting. With the level targeting, there'd be much less need for fiscal stimulus. The second point I would make is that if we have a level targeting regime, sorry, I lost my train of thought again. Sorry, I forgot the point I was going to make. Repeat the question again. There was something else I wanted to.
We were sort of looking at, I've also lost my train of thought, so apologies for that as well. If we were looking at, you know, are we in danger of throwing, by politicizing an issue which has not been politicized, are we in danger of actually it swinging totally the other way, and letting in people who want to use monetary policy in a very different way from monetarists?
Yeah, so what I would say is that essentially nominal GDP targeting is really not that big of a change for many central banks. In the US, we have a dual mandate for inflation and for unemployment. And I think in the UK, there's something similar to a dual mandate. That is, you don't have just a pure single focus on inflation, right? You also look at other aspects of the business cycle. So with nominal GDP targeting, all you're really doing is sort of formalizing this concept that there's more things that matter for the economy than inflation. You're still going to have a fairly stable inflation rate over time, but it'll fluctuate a little bit with the business cycle in such a way that helps stabilize the labor markets. So I think that you know, it's not really throwing the baby out with the bathwater. It's sort of tweaking the system to achieve the broad goals of the dual mandate in a more effective way than the current system, which is a little bit incoherent and hard to follow. With nominal GDP targeting, it would be very clear what the central bank is trying to do. People would be able to evaluate its success more effectively, but it would still generally deliver the same sort of outcome that we are trying to deliver under the current system. As you said, people already are saying that, in a sense, what the Bank of England is trying to do is sort of similar to nominal GDP targeting.
Fair. Just for the sort of clarification of people listening, the Monetary Policy Committee is written to by the Chancellor of the Exchequer, and he sets out the remit. They usually just reconfirms the inflation target of 2% in CPI terms, and they also say that you're going to have to support the government's broader economic policy objectives for sustainable and balanced growth, as they said in 2008, including price and financial stability. Monetary policy has a role in supporting the economy alongside credible fiscal policy, investment to raise productivity and financial stability, which is about as broad and as sort of vague as you can get. It allows a lot of sort of the problems we're talking about sort of honesty in monetary policy, especially the non-orthodox side of it. I just want to say thank you very much, both to Scott and to Anthony. If either of you want to jump in now with an either concluding remark, and then we'll finish up, and I'll let you know about the next set of webinars that are coming away. Scott, do you want to head first?
No, just to reiterate the importance of using monetary policy to control aggregate demand. It's far more efficient than fiscal policy or credit policy. And the two innovations that I would emphasize most are, one, level targeting, promising to come back to the previous trend line. We should even be doing that if we target inflation. And second, a sort of whatever it takes approach. So once you set that target, do enough open market operations so that the market thinks you're going to be on target, however much it takes, and don't rely on less efficient tools like fiscal policy and credit policy.
Fantastic, thank you. And Anthony?
I guess I'd say, so 2008, I think, was the classic example of why an NGDP target is preferential over an inflation target. At the early stages of this pandemic, I was interpreting it to be a supply shock. And so I was thinking that this is another opportunity for an NGDP comeback. And increasingly, I recognize that it's mostly a demand shock that's occurring now. So in theory, an inflation target and NGDP target should be delivering the same policy. So I've been a little bit concerned that there'd be a lack of appetite, and maybe now's not the time for NGDP targets. But I think that will change. There will be a increasing concern over inflation once the economy gets back up and running, once people are allowed to start spending again. There might be a bit more inflationary pressure. But then also there's a couple of things since 2008. I think there's a much greater focus on financial stability, which I think has an advantage of NGDP targets. And also there's a much greater recognition that CPI data can't be fully trusted. And so I think those are two key reasons why now is a good time to really start addressing this. And I'd strongly encourage people that are watching this to make sure they read Scott's paper that you published today, because that's the classic case for an NGDP target, and it's well worth reading.
Indeed, thank you very much indeed, Anthony. I'm just going to reiterate that call. If you want to head on to the adamsmith.org website, you will find The Urgent Need for NGDP Targeting, Learning from the Last Crisis, written by Scott, out today, and just coming in time as the ex-Chancellor of the Exchequer also calls for the Bank of England to change its target to NGDP. Thank you very much, guys. Really appreciate that. It was an incredible, and I thought genuinely quite thought-provoking discussion about something which is actually incredibly detailed. And tomorrow, if you guys are free, do join us at midday London time as we look at how we can do our duty by Hong Kong. We're joined by the Shadow Foreign Secretary, Lisa Nandy, the head of the Foreign Affairs Select Committee, Tom Tugendhat, and Joshua Wong of Demosisto, and one of Hong Kong's leading campaigners on that issue. Thank you very much, guys. Have a nice evening.
Thank you.
Thank you.